This lesson is all about sources of finance. The objectives of the lesson for sources of finance: you need to show an appreciation of the difference between the need for short and long-term finance. Secondly, you need to identify the difference between internal and external sources of finance. And lastly, you're going to be able to explain the main factors and reasons which affect the methods of finance chosen by a particular business. So what are the different reasons and choices the business has to make when they choose a source of finance? So what is finance? Well, it's very straightforward. Finance is money, and a source of finance is where we get that money from. And we're going to be looking at a number of different sources or different places where we can get money from throughout this lesson today. Is a business that need finance? Well, of course, if you want to start a new business, you need money, so you'll need finance. Maybe if you're going to move into a new building, because maybe your current building is too small, you may need more money. Maybe, for example, if you're going to take over another business, you may need money. If your machines break down, you'll obviously need to replace that, which costs money. And if, for example, internal growth, so for example, if you're going to employ more staff, you'll need more money to pay them. So we've looked at why personal people need money personally, but also we've looked at how businesses need money as well, or finance. So we've got two main types of finance. You've got internal finance and external finance. Internal finance is money that we gain from within the business, and external finance is where we look outside the business to get money. So we've talked about internal and external sources of finance. Internal finance is finance or money obtained from within the business, and examples could be retained profit. So if the cost of something is £10 and you sell it for £15, you've made profit, which is £5. So you can use that profit within the business. So that's money that you've gained from within the business. Cash in the bank: if you've got any money saved up in the bank from the business, you can use that as an internal source of finance. The owner of the business may have his own money which he invests into the business. Again, this is an internal source of finance. And the sale of assets or things that you own. So if you've got if you own a pizza shop and you sell your oven, for example, you might sell it for 10 grand, and that's money you've gained from within the business, and that's a source of finance. So these four sources of finance are all from within the business, so internal sources of finance. So we looked at internal sources of finance, and we're going to look at short and long-term sources of finance. So when we look at internal sources of finance, we've got short-term finance, which would last us for about up to 12 months. And the best example here is cash in the bank. Cash in the bank is a short-term source of finance, which is internal. We've got medium-term finance, which is normally used for between 1 and 3 years. And retained profit, or the sale of an asset, would probably be most realistic to use as a medium-term internal source of finance. And lastly, long-term finance, which is finance that's going to be used long-term for 3 or more years, and the owner's investment would probably be the most likely long-term internal source of finance. So you can see we've looked at short, medium and long-term finance, and that's money that we need immediately, just for a little while, maybe a couple of years, and for the long term, which is 3 years or more. External finance is finance that's obtained from outside of the business. And I'm going to give you a list and quickly define what these external sources of finance are. So an overdraft is where the bank gives you the opportunity to go above and beyond your limit. So for example, if you've got £10 in the bank and you want to buy something for £20, you're going to be overdrawn by £10. So you're going to be in minus £10, and the bank gives you a certain limit which you can go up to in the minus. Trade credit: this is where if you want to buy something from one of your suppliers, he may give you 30 days to pay. A bank loan is when you go to the bank and you ask for money. So if you go to the bank and say, I want 10 grand, the bank would loan you some money, but obviously that money would need to be paid back with interest. A lease: this is where you don't buy a machine or a car, you rent it out as such. So you lease it, but you never own it. So you pay, say, £10 a month to rent it out or to lease it out, but you just use it as and when you need it, and you pay every month. A hire purchase is slightly different to a lease. It's very similar in terms of you pay every month, but what happens is, for example, if you want to hire purchase a car, you'd pay a certain amount of money every month, and once you've finished once you paid your last payment and you finished the £10,000, you then get to keep that car. That car is yours. So you're working towards buying that car over a longer period of time by paying monthly installments. However, you're also paying interest every month on that hire purchase. So for example, if you're going to buy a car for £10,000, along with the interest payments, you'll probably end up paying something more in the region of £15,000. But at least you own the item once you finish paying the payments. Grants. This is a government initiative which, for example, if you're going to build an orphanage, for example, that's going to help young children who have not got parents, for example, the government may give you a free amount of money just to help you out because you're doing a good thing, for example. So a grant is something that you can get externally from outside the business as a source of finance, but you don't pay it back. A bank loan, we've already said that before. A mortgage is like a loan, but it's normally used to buy a house or to buy a building, and you've got to obviously pay that back as well with interest. We've already talked about a lease. And lastly, taking on a new partner. If you're a sole trader and you've run out of money for the business, an external source of finance could be taking on a new partner and giving him ownership of the business, and so he can invest some of his own money into the business. Obviously there, what you're doing is you're getting someone else's money. What you're losing though is the ownership of the business. You're going to give him some ownership and you may lose control of your business because you're going to have a new partner in the business. So in terms of, again, short, medium and long term external sources of finance, an overdraft and trade credit would probably be something you'd use just in the short term. You wouldn't use an overdraft facility to buy a new building because it's only used for short term emergencies. Medium term, between 1 and 3 years, you'd probably use a loan, a lease, a hire purchase or a grant as an external medium term source of finance. And long term, you're looking at loans, mortgages, leases, hire purchases and taking on a new partner. These are large amounts of money that you can gain externally, and again these would be used for larger purchases on a more long-term basis, which is 3 years or more. So we've looked at long-term and short-term sources of finance. We've looked at internal and external sources of finance. We're now going to quickly look at the main issues that a business has when it chooses a source of finance, because obviously a decision needs to be made on how we're going to get money. And we're going to be looking at how business chooses and makes decisions in terms of what finance it's going to choose. So in terms of finance, then it obviously costs. A business has to take into consideration the fact that you can't just borrow money for free. It always comes with a cost, and it's different for certain sorts of finances. All money borrowed needs to be paid back, of course, unless, of course, you get a grant, which is external source of finance. But a grant is the only thing that you can get which you don't have to pay back. So I'm giving you 3 examples. First of all, we've got 3 columns here. We've got types of finance, the description of the finance, and the cost of that finance. Because obviously every source of finance comes with a cost apart from a grant. So an overdraft then. So an overdraft is an arrangement with the bank to go past zero or into minus for a short term. So if you're going to buy, like for example, we said before, if you're going to buy a machine for £5,000 and you've only got £4,000 in your account, if the bank allows you to go overdrawn, you can then go into the minus of £1,000. But the cost of that is that when you go overdrawn, or when you go into minus, you may have to pay interest. A mortgage or a loan, this is a long-term loan for a big amount of money to purchase a building or another expensive item. Again, the cost of this finance is that you've got to pay it back first of all, but also you've got to pay that back on top with interest. And lastly, taking on a new partner or issuing shares. Now this is really good because obviously people are coming into the business now, and you give away part of the business, but you're getting more money because you're raising more money through taking on new people and new shares and new partners within the business. The cost of that, however, is that because you're taking on new people and you're issuing new shares out, you lose control of the business because you're splitting the ownership by taking on a new partner or issuing shares, which means that you have less control of the business. Also, because there's more owners in the business or more shareholders in the business, of course profits need to be shared out equally as well. So you lose shares, you lose profit, or you lose your share of the profit, sorry. So today we've looked at sources of finance, short and long term finance. We've looked at internal and external sources of finance, and we've briefly gone through the costs of finance and the reasons or the issues that a business may have to consider when choosing a source of finance.